Our extreme risk theme differentiates us widely from market consensus because it's dealing with a single, hugely important topic, and that is the potential end of a monetary system that's been with us for around 40 years. And that's well beyond the time horizon for most market participants, so any change to a monetary system would be a huge market event. Now, what do I mean by that? Well, monetarism is starting to impact the world in ways that were unintended, and I'll point out two of those considerations. The first one is that zero interest rates jacking up asset prices is actually leading to quite widespread inequality. Those who own those assets are happy, those who don't are obviously losing out in this race, and that was something that monetarism was never designed to try to solve for. So you can expect there to be a populist backlash against this monetary system at the ballot box, and we're already seeing that. But the second component is really about the inner workings of how markets function. We're in a world where you have $17 trillion of debt trading at negative yields. If you give your money to somebody, essentially you have to pay them to take it. In Scandinavia, you have negative mortgage rates where the bank will pay you to take on a mortgage. This is madness, and it's a sign of a broken system, and the subsequent response to that in terms of fixing that system is something that offers a key once-in-a-generation market opportunity for investors. The response to negative interest rates is going to be policy change. And what that policy change is likely to look like is, firstly, you're going to see greater government involvement in the way that wealth is distributed. You may see a change in the heavily deflationary dynamic that we've had in the market for the last decade. The resurgence of inflation is a distinct possibility, and one that is in no way priced into markets as well. And then finally, there will be a social narrative to address this issue of inequality. The appointment of Christine Lagarde at the head of the ECB is a very important moment in history, because this is somebody who has written a $60 billion check for Argentina in the recent past, and in the future is likely to write an even bigger check as she attempts to expand the mandate of institutions like the ECB to, for example, address climate change. So when we look at how central banks are functioning, how they see their scope, and the people who are running them, we're going to be looking at an entirely different market. And how you implement that in a portfolio comes down to having hedges in there that can protect you from these seismic changes in how wealth is distributed. In other words, you need to have some safe havens in your portfolio, because we anticipate that there will be moments in this market transition where very few things in the market are working for you. And two of those safe havens would be the very safest US banks, because US banks had their crisis a decade ago. Their balance sheets are as clean as they've been in probably a couple of generations. And then a second safe haven, which is of great interest to us, is gold. And gold mining equities as a whole are a very interesting safe haven, because they don't have counterparty risk, because they fall outside of the world's financial system. So this combination of safe US bank deposits and gold mining equities come together to form our extreme risk theme. We incorporate gold in the extreme risk theme principally through ownership of gold mining equities. Now, gold mining equities have historically not been a good investment. The industry has a terrible track record of capital allocation and poor M&A activity. So we think that it's important to own the best house in the best bad neighborhood, and for us that means owning the 3 or 4 high quality names with management teams that we know and trust, and the very best asset bases that they can then use and produce in order to fulfill this important role in our portfolio.